it. Now to help us focus on the fundamentals behind the technicals, we've got Ben Cook, portfolio manager at Hennessy Energy Transition Fund, joining us. Ben, welcome. Just looked at the move up in the S&Ps. Sometimes it can be tough to buy at historic levels such as these, but you think energy stocks represent attractive opportunities still at these levels. Look like you think current sector valuations are attractive still relative to historic norms.
Yeah, we do. And again, Ben, thank you for having me. It's good to be back with you. Our view is that 2024 stands to be a good environment for traditional energy equities. And, that's predicated on a view that, global demand for crude oil will advance this year on the order of 1.5 million barrels a day year over year. That's lower than it was last year. But importantly, with moderating U.S. production growth, that'll allow some cover to OPEC to bring back volumes to market, which ultimately will diminish the spare capacity figure that's been built up over the last, call it, year and a half. And as that spare capacity diminishes, we think crude oil prices will remain buoyant, and that should set up well for energy equities.
Yeah, Ben, I feel like it was that, recently comments from the IEA that sent crude up to 83. They were talking about that moderation in terms of U.S. production, and they were also talking about demand increasing, right? That's kind of the fixins for, exactly what the bulls were looking for.
Yeah, exactly. I mean, I think there were some fears coming into 2024 that, continued production growth in the U.S. would raise concerns amongst the OPEC quota alliance that continued market share loss would be a longer-term issue. And I think with the moderation we've seen in the U.S., that's emboldened the OPEC quota alliance to continue to restrict output. And that's obviously been favorable. The roll forward of the first quarter cuts into the second quarter, obviously a major catalyst in helping crude to launch itself out of that 5-month $70 to $80 WTI trading range that we've been living in for, better part of 6 months. So, yeah, I think fundamentals are certainly improving. It's a gradual process, but the trajectory is headed in the right direction.
Yeah, a complex environment. And when you're talking about the supply-demand narrative, we like to keep a close eye on that. In addition to, I've been reminding our viewers not to get a false sense of complacency here, right? We still have some geopolitical events that are playing out. I liked what you wrote in your notes. You said, while conflict in the Middle East to this point has not impacted supply, disruption risks remain and could easily prompt an elevated risk premium should output loss occur due to escalating conflict. I mean, a volatile situation, to say the least, here, ongoing.
Yeah, if I'm an equity trader or a futures trader, I've got to be glued to my screen to keep track of the headlines crossing associated with any kind of supply disruption. More recently, we saw drone attacks on Russian refining capacity, which has now knocked out about 600,000 to 900,000 barrels of refining capacity offline there. Those are the kinds of headlines that will trigger an immediate reaction in the market. And, to date, the traffic in, around the Red Sea has been, it's been impacted somewhat. We've seen the loss of life. It's certainly tragic. Supply routes have been remapped, and the market's figuring out a way to manage that. But these headlines are critical and need to be watched from a trading perspective.
Absolutely. I think that's good advice here. I always like to remind our viewers of that anytime you have exposure to these products, or just us as consumers, right, or market watchers in general, we have exposure to these shocks. Let's talk a little bit about the transition to cleaner energy sources. I also noticed in your notes you pointed out how global policymakers are wrestling with the issues of promoting sustainability while simultaneously dealing with the challenges of both reliability and affordability. But you think that these headwinds to the transition, they're going to persist?
Yeah, we do. If you map the supply chains for the materials and minerals that are required to build out the infrastructure to facilitate the energy transition to, the electrification across many industries, transportation, power generation, et cetera, what you'll find is that the gating issues associated with extracting those materials and minerals are limiting in terms of the pace at which the transition can unfold. And as you put it, with my notes there, there is a cost that comes with that. And I think what we're seeing, and it's not just, the raw material costs, it's we're seeing higher interest rates impact the decision-making process for many of the project developers, particularly for wind and some solar projects. If we've seen some decisions to back off the pace of development. But there's real-world practicalities associated with costs that need to be balanced when when you consider the pursuit of the goals of sustainability and reliability.
Ben, talk to us about a couple companies, a couple stocks, a couple individual names you have your eye on, a couple names you think could benefit from this environment.
As a general rule, we're looking for companies with great assets, low-cost structures that afford resiliency and commodity market volatility. We're also looking for good balance sheets with a visible path to improvement and, of course, great management teams. And the companies that combine all of those factors, in our view, at this point in time, include ExxonMobil, having obviously a great deal of success in Guyana, obviously headlines recently with Hess and right of first refusal there. But Exxon, obviously, as an integrated company, possesses, a variety of businesses that afford, the flexibility to profit in both good times and bad with the commodity cycle. ConocoPhillips, also a great operator in the upstream space here in the U.S. They have an enviable suite of upstream projects with a global footprint. They are at the top of the list when it comes to generating strong returns on capital and returning capital to investors. And then Cheniere, when you think about the pause that was recently announced by the Biden administration on approving non-FTA LNG export facilities here in the U.S., Cheniere has a great, first mover advantage with a significant capacity base of LNG export capacity that will continue to generate a significant amount of cash flow that will ultimately make its way back to the balance sheet in form of debt reduction and share repurchases, as well as dividend hikes over the long term. So those are three names, in our view, that are well positioned in today's market to benefit not only from fundamentals right now, but the longer term outlook for the energy transition.
I like it. Energy sector that's fueling the fire in many ways, could or continue to, I guess, the upside, one that's firing on all cylinders at this point. Ben Cook, appreciate you joining us here, portfolio manager at Hennessy Energy Transition Fund.